Have you ever just looked at a giant company like Amazon or Apple? You see these valuations, hundreds of billions, sometimes trillions of dollars, and you just think, how? How is that value actually, captured on paper?
Hmm.
You can't just be their buildings or the cash they have, right? There has to be more to it. Okay, let's unpack this. Today, we're doing a deep dive into something really fundamental from intermediate accounting. It's absolutely crucial for understanding how companies are built, how they're funded, and really how their value gets presented. We're talking about stockholders' equity.
Right.
You probably hear different names for it: shareholders' equity, owner's equity, maybe corporate capital, or sometimes just plain equity.
Exactly. And what's really fascinating, I think, is that while it might sound like, just finance jargon,
A bit dry, maybe?
yeah, a little bit, but it's actually like a window. It gives you a view into a company's financial health, its structure, how it got its funding. So our mission here really is to clearly explain what stockholders' equity is, break down those key parts.
The building blocks.
The building blocks, exactly, and show you why it matters so much. We'll even look at a real-world example like Amazon to make it concrete.
Okay, so at its simplest, we know that basic accounting equation: assets minus liabilities equals stockholders' equity. It's like what's left over for the owners after all the debts are paid.
The residual claim, yeah.
But the interesting part is that this leftover bit isn't just one number, it's broken down, right? Each piece tells a story about the company's journey.
That's the key. It's not monolithic.
So let's peel back those layers. Beyond that simple equation, what actually makes up this equity piece? What are the core components on the balance sheet?
Great question, because like you said, each component tells a different part of the story. First up, you've got the capital that comes directly from investors. We usually group this as common stock, preferred stock, and additional paid-in capital. This is basically the money a company raises when it first sells shares or other kinds of equity instruments.
So like the initial buy-in from the owners?
Pretty much. It's the initial capital injection, and that additional paid-in capital, or APIC, that's often the really big number in this section. It represents how much investors paid above the stock's nominal par value, which is usually tiny. It's closer to the actual cash raised.
Okay, that makes sense. What's next?
And you have retained earnings. Now, this is often a huge component, especially for established, profitable companies. It's simply the grand total of all the profits the company has ever made over its entire life that it hasn't paid out to shareholders as dividends.
So the money they kept in the business, reinvested profits.
Exactly. Management chose to reinvest it, maybe to fund growth, pay down debt, buy new equipment, R&D, you name it. It's like the company's internal savings account fueling future activities.
Right. So thinking about a company like Amazon, which obviously has huge retained earnings, why would they still issue more stock sometimes or take on debt? Couldn't they just fund everything internally?
That's a really sharp question. And it gets to the heart of corporate finance strategy. I mean, yes, massive retained earnings give you a fantastic internal funding source, but companies still issue stock for big moves, maybe a huge acquisition that needs more cash than they have on hand, even with those earnings, or entering a completely new, really capital-intensive market.
Yeah.
And debt has its own advantages.
Hmm.
It offers leverage. The interest is usually tax deductible. So even for a cash-rich company, sometimes borrowing makes more financial sense for specific projects. It's all about finding that optimal mix in their capital structure.
Gotcha. Balancing act.
Definitely. Okay, moving on. The next piece is treasury stock. This one's interesting because it actually reduces equity.
Yeah.
Treasury stock is when a company buys back its own shares from the open market. So they're taking shares out of circulation.
I do that.
Several reasons. It can boost earnings per share because there are fewer shares outstanding. It can signal management's confidence, like they think the stock is undervalued. Or maybe they need shares for employee stock options. But the key accounting point is it shows up as a negative number in the equity section.
It reaches a total pot. Okay.
Right. And the last main component is accumulated other comprehensive income, or AOCI.
That sounds technical.
It is a bit wonky, but it's important. AOCI captures certain gains and losses that impact equity, but for various accounting reasons, don't flow through the regular income statement. Think of things like unrealized gains or losses on certain investments, or adjustments from translating foreign subsidiary financials back into the main currency. These hit equity directly. It's sort of a holding area for specific value changes until they're formally realized.
Okay, so let me try and picture this. It's like the company's total ownership value isn't just one big bucket.
Right.
You've got different reservoirs, maybe. There's the initial cash from investors.
Yep. the paid-in capital,
Then this big pool of profits they've kept and reinvested.
retained earnings,
Then the value of shares they bought back, which lowers the total.
treasury stock, yeah.
And finally, this separate holding area for those specific gains or losses that bypass the main profit calculation. AOCI.
You've got it. That's a great way to visualize it. It shows how that overall owner's claim is built up from different sources and activities over time.
It definitely helps make it less abstract.
Absolutely. And connecting this back to the bigger picture, understanding stockholders' equity isn't just for accountants crunching numbers. It's really vital for anyone trying to get a handle on a company's actual financial position.
Especially given the scale we're talking about these days.
Immense scale, because the financial footprint of today's big corporations is just massive, and their equity structure is fundamental to that.
Yeah, you mentioned a stat earlier. Companies like Apple, Microsoft, Tesla, Amazon, their stock market valuations are often bigger than the entire economic output, the GDP of many countries.
It's staggering, isn't it? We're talking valuations potentially exceeding the economy of, say, Switzerland or Sweden in a given year. That sheer size highlights why understanding the components of their balance sheet, especially equity, is so critical.
So who exactly cares about this breakdown and why?
Well, lots of different groups for related but distinct reasons. First, investors. They need to understand the mix. How much is common stock versus preferred stock? What are their rights? How much did people initially pay in versus what's been earned? It helps them gauge their ownership stake and potential returns.
This makes sense.
Well, creditors, definitely. Banks, bondholders, they look closely at the equity cushion. A strong equity base relative to debt suggests the company is more financially stable, less risky. It means there's more owner money at stake, providing a buffer if things go wrong. It impacts solvency assessment.
So a bigger equity cushion means they're more likely to get their loans repaid.
Essentially, yes, it signals lower risk. Then, of course, management themselves. They relied heavily on retained earnings, as we discussed, for internal funding decisions. Knowing how much capital they have internally versus needing to go outside is crucial for planning growth, R&D, everything.
And regulators.
And regulators, absolutely. They need this information for oversight to ensure companies are reporting transparently and accurately, following the rules like GAAP or IFRS. It's about market integrity and protecting stakeholders.
So it's really not just theoretical knowledge locked away in accounting textbooks.
Not at all.
It has direct, practical impacts on how investors decide where to put their money, how banks decide to lend, how companies plan their future.
Yeah.
It's woven into the fabric of financial decision-making.
Precisely. It's the financial bedrock.
Okay, this is where I think it gets really fascinating. Let's ground this in reality. You mentioned Amazon. Let's look at their actual numbers. What did Amazon's stockholders' equity look like on their balance sheet, say, at the end of 2020?
Yeah, looking at real numbers makes it click. So if we pull up the Amazon.com Inc. balance sheet for December 31st, 2020, and zoom in on the stockholders' equity section, a couple of things jump out immediately. Their retained earnings were huge. $52,551 million. That's over $52 billion accumulated over the years. It just screams reinvestment for growth.
Wow, decades of profit plowed back in.
Exactly. And then their additional paid-in capital was also very substantial. $42,865 million. Again, showing significant capital raised from investors beyond just the minimal par value of the stock.
So those are the two giants in their equity
Big
section.
of far. Then you see treasury stock at a negative $1,837 million. That reflects their share buybacks. They spent nearly $2 billion buying their own stock back up to that point, reducing overall equity.
Okay.
And the other components were pretty minor for them at that time. Preferred stock was zero. They didn't have any outstanding. And accumulated other comprehensive income loss was a small negative, $180 million, relatively insignificant compared to retained earnings or APIC. So you add all those pieces together, the positive common stock and APIC, the massive retained earnings, minus the treasury stock and the small AOCI loss. And Amazon's total stockholders' equity as of December 31st, 2020 was $93,404 million.
Just over $93 billion.
$93 billion. Okay. So seeing that breakdown, the huge retained earnings, significant paid-in capital, some buybacks, what does that tell us specifically about Amazon? And how can, someone listening use that?
Well, first, having that detailed breakdown allows shareholders and analysts to calculate really important performance metrics. The classic one is return on equity, or ROE.
Right, net income divided by average equity.
Exactly. It shows how effectively Amazon is using the shareholders' investment to generate profit. It's a core profitability measure from the owner's perspective. More broadly, just seeing that total equity figure grow over time, which it generally has for Amazon, even with the buybacks, is usually a positive sign of financial health. It means they're either generating substantial profits and retaining them, or successfully raising new capital, or likely a combination of both. Okay, that makes sense. Healthy growth indicator.
But here's where it gets really mind-bending. We just said Amazon stockholders' equity, its book value, was about $93 billion at the end of 2020.
Yep, got it.
Now, what was its market value, its market capitalization on that exact same day?
Uh-oh, I feel like this is going to be a big number.
It was, wait for it, 1,599,153 million, basically $1.6 trillion.
Whoa, okay. $93 billion on the books, $1.6 trillion in market value. That is a huge difference, more than 15 times. What on earth accounts for that massive gap?
That gap is incredibly important. It perfectly illustrates that the market value of a company, especially a tech giant like Amazon, often goes way, way beyond just the assets minus liabilities recorded according to accounting rules.
So what is the market seeing?
Investors are pricing in a whole host of other factors, many of them intangible. Things like Amazon's incredible brand recognition, its customer loyalty, the power of its network effects, its dominance in e-commerce and cloud computing with AWS.
Innovation, future growth prospects.
Exactly. Potential for future innovation, the quality of its management team, its perceived moat against competitors, even things like sustainability efforts now. These are all incredibly valuable, but they don't typically sit neatly as assets on the balance sheet under current accounting standards.
So the book value is more like the historical accounting record of capital and retained profits, while the market value is the collective bet on the future and all those intangibles.
That's a great way to put it. The market is looking at future potential and perceived strengths that aren't fully captured by traditional accounting equity. It's the difference between the company's recorded financial position and what investors believe it's worth and capable of achieving.
That really puts the accounting number in perspective.
Eh,
It's crucial, but it's not the whole story the market is telling.
Not by a long shot, especially for innovative, high-growth companies.
Okay, so we've covered what equity is, the components, why it matters, and seen it in action with Amazon. Now, just briefly, how does the accounting for this actually begin? Where's the starting point in the books?
Right. The starting point for recording anything in stockholders' equity typically happens when the company first issues stock, either common stock or preferred stock. That initial transaction brings capital in and creates the first entries in the equity accounts. Of course, there are more complex scenarios accountants deal with, like stock issued bundled with other securities, or stock issued to pay for property or services instead of cash, or certain types of redeemable preferred stock. The accounting gets detailed there, but the fundamental trigger is usually that initial issuance of shares.
Got it. That's the kickoff point.
That's the kickoff.
Okay. So we've really unpacked stockholders' equity today, from just the basic definition and digging into all those components to seeing why it's so vital for analyzing a company, and even looking at how a behemoth like Amazon lays it all out. You can really see it's much more than just some numbers on a page.
Absolutely. Hopefully, this deep dive has given you a clearer, sort of comprehensive, and maybe even student-friendly picture of what stockholders' equity is all about. Understanding this foundation is just so key if you want to interpret financial reports properly or make informed decisions, whether you're investing, managing, or even just curious about how these huge companies actually function financially.
And it definitely makes you think, doesn't it, about what really constitutes a company's value. It's clearly more than just the physical assets minus the debts listed on the balance sheet. The market often sees, well, something much bigger, much more forward-looking.
That gap between book and market value tells a fascinating story in itself.
So maybe a final thought for you to chew on. Next time you see a company's stock price fluctuating, think beyond just that market number for a second. Consider what its reported stockholders' equity, that book value, tells you. What's the story of its past funding? How much profit has it reinvested over time? And how might investors be pricing in all those invisible factors, reputation, innovation, future hopes that don't show up so neatly on the accountant's ledger? What hidden narratives might be embedded in those equity numbers?